Hey everyone, it's Karen, and I'm here today with David Welling, and we are talking about everything having to do with financing for people who are thinking about buying a home. So we're so excited. It's like Tactical Tuesday here today, right? We just had some lunch. We had a great meeting. We've been talking about some of our clients. We're waiting for some people to get online, so that's what we're waiting for, right? If you're online, make sure to like us, heart us. If you have any questions, post them up here. David has been generous with his time so far, and I just wanted to ask him some questions when it comes to financing. Many people might not know this, but the banker is probably the most important person in the home buying process, right? Would you agree?
I would say we're up there. I mean, the engine is still very important too, but we are an important cog in the engine.
Yes. What role do you play?
Well, obviously, when someone is looking to purchase, their finances, getting the right information, doing a consultation to make sure they find out not just what they can be approved for, but what they're going to be comfortable paying over the course of time.
Right.
So our role is to make sure we sit down, talk about the different options, look at it from not just the perspective of the bank, but what they're going to be able to handle in the future if life changes. So we want to make sure we talk about all the ins and outs of the financial picture of owning. Because once you buy the property and move in, that's exciting, but you still have to deal with the responsibility over time.
We always say, welcome to debt, right?
Exactly.
At the closing table.
It is a good debt, but it's still a big responsibility.
Right.
Yeah,
but that's important because lots of people think, oh, I'm renting right now and I spend X amount of money and I could spend the same thing owning, and it's not always that black and white. Right,
yes,
depending on their long-term goals. David is from a larger bank here in the city for security purposes. We're not going to say what it is, but if you want his contact information, you can contact me. But just know that we're dealing with a reputable banker here, okay? Okay, so David, common question that I guess get asked is, what is the difference between a pre-qualification and a pre-approval?
Yeah, it's interesting because I think sometimes different banks, they have different jargon, what they classify things about. I would say though, getting a letter from a bank obviously is very important when you're going out there to make offers and you need to get financing. When someone comes to the bank and wants to get a basic letter, have their credit check done, and just get something quickly, normally we'll consider that to be a prequalification, which is nice. It's helpful. It gives some credibility. It shows that your credit score is in pretty good shape and that likely you should be okay if you verify what you provided, but we know there are certain people out there, some people that might be in very high positions in this country who may state they make X, but really make Y. You never know for sure. So if someone does the more formal process, like a pre-approval, where the bank goes through the underwriting transaction of getting your income documents, your asset documents, going through a lot of that work, it makes it a lot stronger, a lot more credible, and also can help you potentially with the timing. That if you can show, I would say more for maybe a condo, even a co-op to get your board package in, that if the bank has done a lot of the work, that means we're very far ahead of the game. That when someone gets a contract, there's not as much work to be done. There's still work to be done, but that may help speed up the process of getting your board package together if you want a quicker closing on a condo.
Because it's already gone through some underwriting.
And there's usually some back and forth with the underwriter, but getting a lot of that stuff out of the way. I've had a couple of customers that actually did a couple of rounds back and forth with the underwriter, submitted their documents, underwriter had some follow-up questions, and they did the back and forth prior to signing the contract. So by the time they got the contract, much of the work was done. Not all of it, but much of it, which really helps.
And when you're making an offer, most brokers do want to see a pre-approval letter. Most sellers want to see that pre-approval letter because it just gives you one more level of like security, right? And the sellers want one extra level of security for the buyer. Yes?
Makes sense,
Okay, locking in rates. I think everybody wants to know, when should I lock it in? How do I lock it in? Will my banker call me the minute it drops to a certain rate? Like, what are the rules, those standards?
Well, I would say generally speaking, and there's sometimes some caveats and asterisks to put on some of the statements, normally you lock into your rate when you get a contract, because normally a bank is locking into a rate specific to a property.
Right.
So up until finding a property and basically being in contract, rates are going to change every day with the market, almost like buying a stock. So while it's good to get an idea of where things are, maybe to crunch some numbers, I always tell people, if you're looking over the next handful of weeks and you're trying to get some information, which is helpful, always have a little bit of a buffer into your budget, because you never know what's going to happen in the markets, and since you lock in later on when you get the contract, you don't know what the ultimate rate's going to be, so it's good to kind of add a little cushion there.
To wait, And the question there is, should I shop rates, and how long can I shop for, right? And how many pre-approval letters? I get this question all the time. Well, I'm going to call this bank and that bank and that bank, and they're all going to run credit, right, for the most part, in order to get the pre-approval.
Well, here's the thing. I would say a bank, yes, has to ultimately run a credit report. But if I have a client that has spoken to another bank and has a credit score, we can give them a rate, and a lot of banks can give a rate with the assumption that the credit score is X, Y, or Z. But the person does have to understand that when we pull the credit report and something comes in differently, that could adjust the numbers. But if someone just wanted to get an idea prior to the credit check, it is possible to use an assumption. But usually, at some point, the bank will have to, every bank that's looking to do the transaction will have to run a credit report.
Okay, good to know. And locking in rates, standards like 45 days, 90 days?
Every bank's a little bit different. I would say most banks that I know for a co-op, I would think probably 90 days at least, just because the co-op process takes a long time. For a house or a condo, I would think 60 is more average, but everyone you talk to may have a little variation here or there, but just as a general norm in New York City, co-op, it should be at least 90, because you don't know what the time frame is going to be with not just the co-op part, but you could actually have a sponsor sale and everyone's done pretty quickly, but the attorney for the co-op is on vacation for 2 weeks and they're going to be in court, and so you just never know what the parties or if the seller wants to push things back. Co-ops always a little trickier, so 90 days is typically recommended.
And do you do pay extra the longer you lock it in, right?
Well, as a general rule, yes. But a lot of banks, I can't speak for all of them, but I think some of the bigger banks for a co-op will often give a longer free rate lock, knowing it takes longer, but it's really, every institution is slightly different. But, so I don't know if everyone's going to charge, but just normally, if you're buying a house and you want to do 60 days versus 90 days or 120 days, in the industry, the further you go out, there could be some cost there, but you got to double check with the institution you're talking with.
And I don't know if I can ask this question, so you tell me. Rates, you see them going up. They have been going up.
Well, what I tell people is that if I knew it was going to happen with rates, I'd be in the Caribbean or behind bars. No one really knows. I mean, yes, the trend has been going up. But, being conservative, I'm always nervous that they'll continue to go up, and if I have the opportunity to lock in, I'd like to lock in and not worry about it. But things can happen in the world that people don't expect that can cause it to go in a different direction. Just like Brexit. No one predicted that was going to happen, and then mortgage rates went to all-time lows. I remember a couple of years ago, was it Bill Gross from PIMCO predicted that mortgage rates and all the rates are going to go up a lot because the U.S. credit rating was going to be downgraded. Everyone was freaking out. What happened? It went the complete opposite way, and the markets crashed and rates went down. So yes, the trend has been up. But no one really knows for sure. Yes, you would think it's going to continue to go up, but I never like to make real predictions, because there could be some global event and everyone freaks out and moves money to the U.S. and makes mortgage rates, which are a little different than what the Fed is doing.
And so, that's a huge difference, right? That's like a myth. Like, people think, rates are going up, but it doesn't always impact mortgage rates.
I would say the last 3 times the Fed has raised rates, mortgage rates have actually trickled down a little bit. Could that be just traders reacting? Could that be the fact there's other economic news, or was already priced in? Could be a lot of things, but it's not necessarily hand-in-hand relationship. In fact, there was an article, it was in the New York Times a couple of years ago, how Ben Bernanke refinanced his personal mortgage in 2011, and then a few months later, mortgage rates plummeted. And the point of the story was, the writer was saying that Ben Bernanke, who ran the Fed, didn't know what the mortgage rates are going to do. How does anyone know? But again, the trend has been up, and if I had to predict, which I don't like doing, I'm always concerned that they're likely going to move up, but you just don't know. There could be some event or something that happens where things calm down.
But they're still at all-time lows. I think my parents got 16% back in the 80s. So to get 3, 4, 5% is like,
Yeah,
it's
and
still
it's-
really low.
And you never want to poo-poo the differences in the rates if they go up and it's real money and it can impact people's budgets. But I think there is a psychological component to it.
Yes.
Again, not that people want to pay more money, no question about that. But if someone was like obsessed and shopping for a property thinking the rate was going to be X, and then they call back a couple months later and it's Y, their thought process is going to be very different than someone who's calling now who has the expectation it's going to be at a still good range.
Right.
They're kind of like, okay, that's what I was expecting. I can't go in the past, just like if I wanted to buy a stock.
Right.
Now, I'm not going to dwell about, oh, where was the stock market when it crashed 8 years ago, 10 years ago?
Right.
It's all relative to kind of things going on now. Of course, your budget can be impacted. There's no question about that. But just focusing on the rates, they're still in pretty good levels.
Yeah. As a broker, I see that as rates go up, oftentimes prices come down, just to balance it out, right? Kind of like with maintenance or with common charges. The higher the maintenance and common charges, sometimes the lower the price. So it's a dance, right? And the buyers and sellers have to react, and they are right now. They are. So last question: is the 30-year fixed rate the best? Most people do that, right?
Well, I would say it's the most conservative. It's the most vanilla.
Okay.
But like a lot of things in the process, it's not a one-size-fits-all.
Okay.
So a lot of people that want to be safe and conservative and not worry about the future, it's a good way to go. Rates are still excellent. But there are some situations where someone is like, oh, I'm definitely going to be out of the property in 5-7 years, no ifs, ands, or buts about it. And they want to get a little lower rate by doing an adjustable rate mortgage or an ARM as we call it. It's risk reward. You got to see, what are you saving and is it worth the risk? Because what I tell people is, what if life changes? What if you decide that things are going great and you want to move, let's say, out of the city, keep it as a second home? Well, then the rate will matter long term if you keep the loan.
Right.
Or what if you decide that you can keep it as a rental property? Then long term, if you decide not to, or you don't have the ability of paying off the loan, you're going to care where the rates are down the line. Now, if someone bought, a studio co-op and they 100% are going to be gone in 5 years, and they wanted to take an option that protected their rate for 7 or 10 years, and that was enough cushion, for them that may make sense. But I tell people, think about what could be, and is it worth the risk to do that? So a lot of people not knowing where the future may be, often prefer the 30-year fixed.
Okay.
So
that's fair.
Not a one-size-fits-all.
Yeah, good answer.
Thank you.
Anything else you think buyers should know these days? Do we have any questions?
Besides that you're the best realtor in the industry?
Oh, that's nice of you. Thank you.
I mean, as far as generic information, I think that's a good way to start. And then, everyone, again, situation is different. So talking to a professional to do consultation, ask some questions, because you may have something specific that's very different than the next person. You want to make sure your information gets looked at, questions that you have specific.
We actually were talking about the value of using a bank, especially for those of you thinking about New York City, using a New York City bank, right? There are some banks that credit unions, for example, in the middle of the Midwest, if that's where you currently have your primary residence, you probably don't want to go there for a New York City residence.
Yeah, obviously you want to deal with someone who's credible, but also someone who knows the market. When you're dealing with co-ops and condos, there are a few good lenders out there, but you want to make sure they know what they're doing. That they're not going to get tripped up over something so basic, that co-op financials or something that most banks in their co-op department can kind of go through pretty easily, with a bank that has no idea what people are talking about.
What a co-op is, right? David's not only looking at the buyer, but they're looking at the building. So if they don't know what to look for in a building, good luck, right? So, so David is definitely a reputable banker for the New York City and beyond. But you cover what other markets?
All 50 states.
All 50 states. Good to know. Yeah. All right. Yes. Co-ops, condos, houses, mansions.
And if you're buying in Hawaii, I'll definitely do the appraisal myself. I'll go out to the property.
You're taking me with you. All right. Well, thank you for your time.
Thank you for having me.
Everybody. If you have any questions, just leave them on down below, and we'll see you later. Bye.